We are looking at problem 1211 in your book, and I've added some, just right off the top, I want to just tell you I've added some things here because I don't think that this problem does a very good job in actually helping you understand what you need to understand about this. But let's just work through the problem first, and then I'll talk about why I think this problem is incomplete. So we have a company that is looking at trying to value his stock. It's trying to make a evaluation on its stock per share. So what we know is that this company is going to pay a $4 per share dividend. So we put that here. And then we know that it's going to it's expecting a constant growth rate of only 1%. So we'll put that here. And so we're going to use actually 1%, not 100%. Okay. So, and then we have a required rate of return in the market of 16%. So in the industry. So we'll put that right there. And we're going to use the 16%. Wow. And so we're going to use the constant growth version of the dividend valuation model here. And I put that formula in, you can see in cell C15. So we have a present value, what we're calling the present value of one share of the stock based on the expected dividend and the required rate of return. Now, what is misleading about this problem is it's asking you what is the stock's dividend yield, and that's just simply the dividend price divided by the present value, and it's going to be a little bit less than the required rate because it doesn't take into consideration the growth rate. So what all this is saying is that if you look at if you already know your required rate of return and you know your dividend, then you can compute the present value of the stock. It's going to give you an exactly 16% return when you count the growth rate. So if we come down and look at these formulas that I actually added down here, and we look at what the book says about the dividend yield, we want to look at the KS, which is the required rate of return in the market, which in this instance is 16%. So I put in a formula right here that is this formula, which is the dividend yield formula plus the growth rate, and that is just saying that when we have a value of the stock at 26.67, then the return on that stock with this price is going to, and this growth, and this dividend, and the 1% expected growth rate is going to be exactly equal to the required rate of return. The reason why the dividend yield formula right here is 1 percentage point less is because we're not, in this formula right here, if you look up, we're just saying the dividend divided by the present value, so we're not adding in the 1% growth. When we add in the 1% growth down here, we get the 16% required in the market. Now, why is this really important in terms of making a decision on whether to buy the stock or not? Well, if we put that current price in, I've actually got a formula right here that is going to allow us to put whatever current price in for the stock that we want. So we put in the present value that we computed up here of 26.67, then we're going to get a return or an expected yield of 16% equal to the market. But if you look at this bottom little paragraph in your book right here, if the return is less than the required rate of return in the market, then you wouldn't want to buy it. So let's say the price is higher. Let's say for whatever reason the price now is $30 with the same dividend and the same growth rate. Then that's going to mean that the expected yield on this stock now, because you're paying a higher price, is only 14.33%. So you would not want to buy it. So if this stock is anything over the present value that we computed right here, so say we put in 27, then it's still going to be just your yield's going to be lower than your required yield in the market, so you wouldn't buy it, even if it was 1 penny more. 26.68. It's still going to be just below what you need to have. So this is why this alone, just the dividend yield, really, that doesn't help you a whole lot. You need to actually use this formula right here, the dividend yield plus the growth rate, to compute, to figure out whether the interest yield is going to be high enough to actually warrant buying the stock. Okay, so I hope that makes this problem right here make a little more sense to you.